Welcome to Project Business Basics, designed to give you the tools to make smarter financial decisions. Whether you're looking to learn something new or just want a refresher on some basic economics, there's a place for everyone on our show. I'm Archid Janarkar, and I'm your host. Now, a few episodes ago, we had talked about options, which are a special method of buying and selling stocks, or any financial assets for that matter. A quick refresher: calls are a type of option contract, where if you buy a call, you pay a premium in order to have the right to buy a stock or an asset for an agreed upon price, known as the strike price, by a certain day. And puts, if you buy a put, you pay a premium in order for the right to sell a stock at a particular strike price. And on that episode about options, we had mentioned that we weren't going to discuss option spreads at that time, and the reason for that was that we didn't want to complicate it too much. Well, now that you know what calls and puts are, we can begin to start talking about option spreads. In simple terms, option spreads are combinations of various options to make money. There are things like buying different call contracts and different put contracts that have different strike prices and expiry dates. And to help us learn about option spreads today, we're going to be bringing in a member of an organization known as Eagle Investors. And Eagle Investors is a business that focuses on trading options, specifically option spreads. And with us today from Eagle Investors, we have Mr. Oliver Rios. And Mr. Rios is going to help us understand a few things about option spreads, and he's also going to tell us a little bit about how Eagle Investors works and what it does. If you don't understand some of the terms from our interview today, it's okay because we'll be discussing the mechanics of various option spreads in the future. So let's get started. First, why don't we start off then with some downsides of dealing with single calls and single puts? And for our listeners, single refers to buying just X number of contracts of just one option with one strike price and one expiry date involved in the entire transaction.
Okay, so there's some downsides to it, and then there's some upsides. So it really depends on your goals here. The way that I see it is that it depends on what volatility is doing. So when I'm entering a trade, if I were doing a single, it would be in the expectation that volatility is about to expand, or there's about to be a very wide range. But the downside to it is that there's a psychological cost. Like mentally, you're just going to be kind of waiting for that movement. If that movement doesn't happen, then you're just going to lose money because there's a time premium associated with buying singles. So there's an intrinsic value depending on how far in the money you're buying. And then there's also an extrinsic value, which is the time-based aspect of options. So the time base is usually what kills single options for most people. So definitely a downside when you think about it, but there are upsides if you're trying to do a stock replacement type trade. So it really depends.
So then, with these inherent risks or these downsides of buying single calls and single puts, what exactly are option spreads and what's the benefit of using them?
So an option spread to me is kind of like a way of defining risk and kind of still going after those opportunities that you're wanting on a directional basis. So option spreads are a way of defining risk, and you can use different things to figure out the best probabilities of these options of working out. So I guess the way that I kind of looking at it is being able to define the risk. You can define both the win side and the loss side, and it really depends. Like you can really mold it, kind of like if you think about like Batman with his utility belt. Like, I mean, if you look back at like the 1930s or 1940s comics, he always has some kind of gadget inside his utility belt. So that's kind of like the way that I think about spreads. It's kind of like you can pull it out in certain situations to handle a certain mystery. And the mystery is, where is price going next?
And the
I'd say.
mechanics of it are just buying, instead of just one call or one put, you'd buy either multiple calls or combine a call and a put or multiple puts like that.
Right, right. So it would depend on your objective. Are you expecting volatility to expand? That's where you could do something like how you're mentioning buying multiple calls
Hmm.
and selling some on top, like a back ratio or a calendar or a diagonal.
Hmm.
Or if you're going for a more conservative approach, you could do like a bull call spread where you buy a call and then you're expecting price to go up, but you're going to cap that risk or, cap the time premium by selling a call a little bit above it. But
Hmm.
you can also use this, you can use spreads to earn income, which is what a lot of traders do. That's kind of like a bull put spread where it's kind of taking advantage of the time premium and also the psychology of the person that's expecting more downside or just going in the face of the trend. So you could use certain spreads for different situations. Just it really depends on what your objective is here. Are you trying to be more aggressive or are you trying to be more conservative?
So, what are some types of option spreads, like, say, vertical spreads or just categorizing credit and debit spreads?
Right. So I mean that's the basic way of describing it. Is it a credit? Do you receive money and do you have to put collateral up in advance to receive that credit? Or is it a debit where you're paying money in order to enter that spread? And if price goes in the direction of that bet, then you will receive a bigger payout in the end.
Hmm.
So those are the two basic ones. But then from there, it's kind of like the Batman situation. There's 30 different flavors of how you can, fight the bad guy. So I guess a basic conservative approach would be like a bull call spread. I mean, right now, whether we choose to believe it or not, I mean, I know we're technically in a recession, but
Hmm.
we're also still in a bull market.
Hmm. You know,
Yeah.
the way
So
the market's just trending up since April. Hmm.
that's right. It's still trending up, and
Hmm.
that's a good way of just staying with the trend is taking this conservative approach, which is called a bull call spread, where you buy a put below and you sell a put above. So
Hmm.
it's kind of like the best way of thinking about credit spreads is kind of like car insurance. When do you buy car insurance? You have to buy car insurance
Hmm.
all the time, right? And in order to get insured on that car, you have to pay a premium.
Hmm.
So by selling credit spreads, you are the insurance company and you're collecting that premium continually. Now, the risk, this is where it's important to be risk defined. The risk is you're putting up collateral in order to receive that premium from, you know, your car payer every month. So you're getting a premium, but you have to put up collateral. Now, this is where you kind of have to judge risk reward. Does the collateral justify the premium received? Because every now and then, regardless of how safe the driver is, eventually they are going to get into a car crash. So generally, how people do this is they expect this is the downside of selling credit spreads, but
Hmm.
they expect that the lower the premium that they receive, the higher the probability of them receiving the premium and not getting clipped. But it's similar to like a turkey on Thanksgiving. Every day it gets fed until Thanksgiving finally arrives and it loses its head. So you got to be careful and you got to make sure one, you define your risk, and two, you have to ask yourself, does the collateral I'm putting up justify the premium that I'm receiving? So that's a basic checklist that I usually go through when I do credit spreads.
And then, how important is it to really know fundamental analysis or technical analysis when it comes to trading options?
That is a great question. Okay, so the way that I see it, fundamental analysis is helpful, and same with technical analysis, that's helpful. But it's more for me, it's less about like what it means to the overall company because I've seen very poorly managed companies do very wild things in my time trading. So it's a given rule that, markets are not efficient no matter how many PhDs you have. The more that you experience the stock market, the more you'll see that markets are not efficient. So these things that we look at, the fundamental analysis, the technical analysis, it just it's more of a psychological effect, you know? Like take for instance PE. A PE ratio can be affected by many things like, what's happening with the 10-year yield. If the 10-year yield is going lower, then the cost to gain capital is getting lower. So a lot of these companies that are struggling are going to be actually having a easier time. And sometimes what you'll see is that companies with higher rates of leverage will actually do better when the tide is going out. So when the tide is going out, over leveraged companies actually do better because they're expected to have growth. I say that with quotes. I mean, look at Tesla. I don't know if you've been
Yep.
keeping track of that
Yep.
that bad
Just
boy.
today it crossed 2,000.
And it's about to have a split. So it's like if you're any kind of financial professional, it's like the complete opposite of anything that you would rationally expect. So sometimes a good story can outweigh the technicals or fundamentals. But if you have, I guess, the technicals and fundamentals kind of supporting it, it gives you kind of a psychological safety blanket.
It gives you that greater confidence
There we
when
go.
getting in the trade.
And that's what it's all about is confidence.
And now, either advice or words of caution. What would you tell to someone who's just interested in and beginning to use options?
Okay. So I I would start out by learning the basic rules of how the Greeks work, but don't necessarily like hold on to every little bit because you'll see like some things aren't like essential, like row for instance, because I mean rates are going to be this low until man like probably 2023 by now. But I would get a basic understanding of fundamentals, technicals, because I mean the best way to think about technicals rather than looking for there's no magical signal in technicals, but how I view it is more like an accordion. There's great moments of consolidation, like think of the accordion going inward, but that often leads to great moments of explosive volatility where that accordion goes out and it makes a very loud sound. So it's kind of like you gotta take advantage and figure out where these moments of consolidation are and figure out how you can tackle this beast before it expands out. Um, Aside from that, I would say a basic understanding of how economics works. Uh, Ray Dalio put out a good video. How the machine works. That's a great one. I do a basic understanding of geopolitics because that's going to play a very very big part, especially with rates being this low going forth. Yeah, I mean, just thinking about geopolitics, my best trade that I've ever done is about 1,500%. That was let's see, this past year OPEC fell apart right before the Corona crash. So I went after a servicing company, which is like a levered play on oil. So it's like 3 times the leverage, and I was doing a leverage product on that. But yeah, I'm just basically saying getting a basic understanding of geopolitics. It's very important to be aware of your surroundings, not necessarily what's going on technically, what's going on fundamentally, because things around us change based on the circumstances of politics, whether we choose to believe it or not. They're the ones that write the rules of how the game is played. Other than that, I would say that before you begin going live, I would start by paper trading. Thinkorswim has a great paper trading system that allows you to try out some of these spreads that we kind of briefly talked about. And in general, it's important to find a broker that you're comfortable with because in certain situations, you're going to need to reach out to that broker. Like if you get a sign by accident or something like that, it's very important that you just reach out to the broker.
And so then why don't we finish then with a little bit about what Eagle Investors does and how it works?
Okay, so Eagle Investors, we're a team of roughly about 10 or so lead moderators. We give alerts, we do text message alerts, we do weekly videos about like what's going on in the market and what we're expecting to come up, I guess, in the sense of catalysts. But yeah, I mean, it's just about fun and enjoying life and figuring out how we can be better traders together. We're not a registered advisor or broker dealer. Basically, what we want to do is we just want to grow as a community and we want everybody to succeed. And it's just a matter of the amount of success is going to come through education. And the more education that we can provide our members, the more value I think that we can bring to society as a whole. I mean, it's basic to say this, but we feel that there will be more equality with more access to equity.
All right, well, I think that about wraps it up. So thank you so much for joining us today. I personally know that option spreads can be pretty confusing to understand, but you've done a great job of just breaking it down in simple terms and making it easy to understand. So just thank you so much for that.
You're welcome.
If you wanted to learn more about Eagle Investors, then the link to their website is in the description. For more Project Business Basics content, you can visit our blog and sign up for our newsletter, which are both available on our website, www.businessbasics.online. I'm Archie Janarkar. This is Project Business Basics. Thanks for listening.